Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Nick Langley. He's the Managing Director, Co-Founder, and Senior Portfolio Manager at Rare Infrastructure. This conversation will cover the full gamut of infrastructure. We will look at how the definition of infrastructure has changed. We will look at the valuation issues that are very prevalent in infrastructure today as we think about cash flows, terminal values, and regulatory risks. We look at building a strategic asset allocation to an infrastructure portfolio alongside the macroeconomic cycle. We look at the composition of both listed and unlisted and how a number of institutional asset owners approach it. And finally, we'll wrap up the conversation with a discussion around ESG issues. I truly hope you enjoy this conversation. How do you, Nick, think about the infrastructure universe and how the definition of infrastructure has evolved over the last few years?
Thanks, Alex. We think about infrastructure from a what is core infrastructure perspective. And really, as we categorize that, we think about monopoly assets that provide an essential service to a community or to an economy. Given that they're monopolies, generally they are regulated or governed by some sort of concession agreement or long-term agreement, such as a power price agreement. But ultimately, they have predictable cash flows over the longer term, and they're generally linked. Those cash flows are generally linked to inflation.
So I guess one of the things that keeps coming up in infrastructure is a crossover almost between real estate and infrastructure. How do you think about that potential differential?
There's certainly an intersection between the two, and it really happens around the communications space from our perspective. And if you think about the different assets within that, you've got your wireless tower companies that are really just a relatively simple piece of infrastructure on a piece of land, dotted across both urban and rural areas. And so that really, from our perspective, does sit in infrastructure in our space, because the contracts around that infrastructure are generally quite long dated, 15 or 20-year contracts. They're inflation linked. But at the same time, those companies are structured as REITs because they own a large amount of land. And so they do sit in the REIT indices and so on, particularly in the US. If you take a step down and say, well, what about data centers? From our perspective, data centers do not meet infrastructure because the contracts that govern the revenue generation are not long enough in duration. We do see the odd one that's out at kind of 15 or 20 years, but generally they're much shorter, up to 3 years in duration. And from our perspective, that doesn't give you the predictability of cash flows that you should have from infrastructure. And then the final area is satellite communication companies. And in the old days, you'd put up these things called geostationary satellites, orbit the Earth at the same rotation as the Earth. You'd sign 15-year contracts on those, and so we would call those infrastructure because when you launched a satellite, you'd have 15 years of revenue pretty much in the bag. Today, with middle Earth orbit and low Earth orbit satellites, and a propensity to do more and more data through the satellite companies, those contracts have become a lot shorter. So those were infrastructure, but in our view, they will no longer be infrastructure within the next few years.
Let's look specifically at toll roads, because these very heavy asset-driven infrastructure projects. How much do you think about the actually underlying assets versus the management that runs these assets? How do you sort of differentiate the business operational piece to the infrastructure versus the actual underlying asset value?
So for most infrastructure companies, the management of the infrastructure is relatively simple. There's no funky technologies or anything like that, and so operationally you don't get a lot that goes wrong. Sure, electricity networks, you've got lots of storms and so on coming through, and you've got to have crews out and fixing them and so on. But for a toll road, listen, you resurface the road every now and again. You make sure that no broken down vehicles sit in the middle of the road, and you fix the potholes. There is another very important angle to it, though, which is non-operational, and that is the relationship that you have with stakeholders. And this is going to become more of a hot button topic over time. And obviously, from the toll road perspective, it's the relationship with government that your concession agreement is often with, the planning for traffic over time, the way traffic moves through cities, around cities, and how that traffic is going to change over time, particularly as we look forward to autonomous electric vehicles in the case of toll roads.
There's a lot to talk about when we think about government and government policy. But before we get there, I wanted to think more broadly around the infrastructure universe, more globally. Obviously, for investors that sit in Australia, what do you see globally that you don't see locally from an infrastructure point of view?
So we've got a reasonable representation of infrastructure locally. There's just not much of it. So when you look globally, we cover about 200 companies in detail with about $5 trillion of assets. Within that cohort of companies, you've got Sydney Airport, you've got Transurban, you've got Horizon on the rail side, you've got Spark and AusNet on the electricity and some gas. You've got APA group with pipelines and so on. So you've got a reasonable range of different infrastructure companies. It's just overseas, you've got a whole lot more of them, and importantly, you've got the ability to diversify different regulatory and sovereign risks and so on as well.
Let's then move to the next stage, which is valuation. Markets are pretty hot just generally. Is infrastructure received that same liquidity boost that the rest of the equity market has seemed to have picked up as well?
Interestingly, not to the same extent. And I'd also argue that the equity market is not homogenous. So there are certain sectors, obviously big cap tech and growth sectors have done extremely well. Value has not done well, and infrastructure as a whole has had some challenges, particularly at the end of infrastructure like airports, some toll roads that are a bit more economically sensitive. And so airports, for example, it's going to take a long time for borders to open and for traffic to return to normal for them. So for a number of those companies, they haven't had the significant recovery that we've seen in other parts of equity markets.
I'm curious, obviously COVID's had a very big impact to a lot of infrastructure. How do you think about the impact to cash flows here and now and for the next few years versus potential real long-term changes to these asset valuations and potentially their terminal value impact?
Yeah, so as we run financial models on our companies, they're akin to a lot of models that some of your unlisted listeners will be running. So we're usually running 30 or 40 years worth of cash flows, and obviously once you get out beyond a few years, you're in a bit of a crystal ball situation, and so you need to break the cash flows down into different components. You've got how is regulation going to evolve over that time, and what implications will that have for your cash flows? What are the potential cyclical implications for cash flows, and then what are the larger secular themes that may come through, and that that may be because of public policy, it may be technological advances over time, the autonomous electric vehicles, for example, and so we end up running a series of different scenarios and sensitivities for our cash flows over time to understand what the different valuation implications might be from a different kind of set of future outcomes.
Earlier you mentioned about government impact, and so I wanted to talk more specifically. We're seeing a lot of political activism, social unrest The cost of living is becoming more and more prominent for people. Infrastructure is a big part of people's day-to-day, whether it's the water, it's the toll roads and so forth. How do you think about that impact in infrastructure more broadly?
Yeah, so conceptually, the agreement between governments and infrastructure companies is that the infrastructure company is a monopoly and therefore agrees to some sort of regulation. But the flip side of that is that the infrastructure company will receive a fair and appropriate return on its asset base. And so as you continue to invest in the asset base to provide that essential service to a community or an economy, then you should be fairly remunerated for that. And listen, I suspect where the rubber is going to meet the road, in the future is government public policy, driven by populations. Let's be clear, is going to push more and more towards green infrastructure, renewable energy, and so on. And frankly, that is going to require a substantial and I mean unbelievably large amount of investment into our infrastructure around the globe. And as that happens and you provide a reasonable return to the infrastructure companies, then the prices that customers pay are going to go up. And that's going to be a bit of a rub where, people want to go more green, but they'll be pushing back against the cost of that because it is going to be, a sizable portion of household budgets.
Is there a risk that you may see more nationalisation as governments try to overcome some of that pushback?
Listen, I don't think so. And I think for the reason for that is that ultimately, governments understand that whilst they could finance these businesses more cheaply, they probably can't run them as well as the private sector can run them. And that's not just, the ongoing operation, but it's also ensuring that, new projects get completed on time and on budget, and frankly, the lights don't go out. Mm-hmm. Just ask California. There's enough trouble already when you don't quite get the regulation or the incentives right. So I think wholesale nationalisation is probably out. The one risk I would highlight though is, in coming decades where we move maybe to a universal basic income kind of approach within societies, it is possible that governments say, well, we've got to try and keep our people productive and maybe we should nationalise some of these assets and have everybody working for the postal system again or something like that. So there are certain scenarios where you could see a big government approach to thinking around universal basic incomes and so on, and that could affect the infrastructure sector.
How do you then take that potential and put it into a risk premium for these assets?
Yeah, and listen, really tricky. There's been a recent example of this with the UK water sector, and when Corbyn was in charge of the Labor Party in opposition, they had a stated policy of actually moving towards nationalisation of key infrastructure. And in the electricity space, it was going to cost them something like 7 percentage points of debt to GDP to nationalise the assets, and your average household was going to save something like £20 on their electricity bills on an annual basis. So a lot of cost in terms of additional debt, not a lot of benefit at a household level. But as we thought about that, we then worked through, okay, what protections are in place, be it legislative or regulatory or bilateral treaties, which the UK has with another number of sovereign wealth funds and so on. What protections are in place for investors? And therefore, commercially, what price would the government have to pay to be able to do that? And if you plug that into your models, then are you able to buy stock now at a reasonable price? And let's be clear, we were able to buy stock in those companies at less than their regulated value, and they generally trade at a 10 or 15% premium to the regulated value in the listed market, and about a 25 to 35% premium in the unlisted market. So we were able to buy those at less than their regulated value, And as the cloud of nationalisation cleared, we're able to then sell that stock and make a pretty good turn of profit on it.
Mm-hmm. Two other inputs that are critical, obviously, to valuation, which is inflation and tax assumptions. I'm curious of what you're thinking there around those two inputs.
Yeah, so inflation is key, and most infrastructure companies have a link to inflation in their cash flow. So, they get to increase their prices by inflation each year, and so they are their valuations are positively correlated to inflation. So if you assume inflation is going to be higher in the future, then actually the valuations in this space should increase. But it plays into cash flows and also into discount rates. So higher inflation should also lead to higher discount rates because your risk-free rate is going to be increasing as well. So there are some offsets there. We run a lot of scenario and sensitivity analysis just to understand how big that implication might be. And we also have the ability, obviously we're in listed markets, so we've got liquidity to adjust the weightings in the portfolio. So if you're moving into a disinflation environment, as say we are in the UK at the moment, then you want to cycle capital away from some of those regulatory regimes that have a direct pass-through of inflation. And in the UK, the regulated asset base or the RCV gets indexed to inflation each year. So as inflation goes down, your asset base inflates by a lower number. If there's outright deflation, then you can have issues with debt covenants and so on. Whereas in the US, the utilities there are regulated on a nominal level. So if you get lower inflation, disinflation, deflation, then actually you're making more money out of those companies. And so the ability to shift capital around in that context is pretty important as well.
That's a good place to transition as you think about the building up of your portfolio. Is there a strategic asset allocation that you then try to match to a macroeconomic piece of the cycle where we are in the cycle? How do you think about portfolio construction?
Well, our approach is to come at it from an absolute return perspective. So, the primary benchmark that we use is G7 inflation plus 5.5%. And so we're trying to deliver to our clients 5.5% real return over rolling 5-year periods, call it an economic cycle. And so we're not starting with an equity index and deciding to go overweight or underweight particular stocks. We're stepping back and saying, where are we going to find the best risk-adjusted returns for our investors? And so we pick companies first, and then the regional and the sector weightings kind of fall out of that approach.
As you think about that composition, how much of these stocks as they sit in the portfolio are really a strategic conversation or almost more tactical in terms of looking at dislocations in valuations and you're taking advantage of those and you're constantly then rebalancing?
So obviously in the listed market, you have liquidity, so you can treat a certain amount of the exposure to a company that has a great set of assets, good regulatory regime, wonderful management. You can treat that as core, and then you can dial up or down that exposure over time. And if you think about it, say from a toll road perspective, and you say, well, I want to own more of that road when GDP expectations and growth expectations are improving, or inflation expectations are going to be higher. I want to own a little bit less of that road if we're heading into a recessionary environment. I'd like to own some more of the utilities because they're not economically sensitive. They don't. Their remuneration doesn't generally change as a result of usage of gas or water or electricity and so on.
How much do you then think the blend or the composition of these stocks is based on the macroeconomic part of where we are in the cycle versus actual valuation decisions?
Conventional wisdom around portfolio construction would say, as you get later into the cycle, you should own more of the utility companies that get remunerated based on their assets. And then as you go through the recession and you come out the other side and you get into a more growth-oriented environment, then you should switch to owning more of those infrastructure companies where they might have the pricing side of their business model set by regulation or concession contract, but they're exposed to volumes. And so therefore they're exposed to economic activity. So that positioning then is partly a macro call, but it's going to be partly your view on the assumptions that you're putting into your financial model. Because if you're expecting, higher growth in the future and higher rates, then infrastructure companies are going to look more attractive than utility companies, and the reverse is also true.
How much pressure do you find in terms of valuations, as traditional fixed interest doesn't really provide the defensive characteristics, doesn't provide the cash flows? Are you seeing a lot more flows then moving into infrastructure assets that have these strong cash flows that everyone's looking for?
We have seen a significant tailwind from investors chasing yield in the sector, and it's gone into property or real estate as well. We launched a higher yielding product about 10 years ago. It did not a lot for 5 years, and then in the last 5 years, it has been a source of significant inflows for us as a business. And that's because it's got a pretty steady income, running yield about 5% or so per annum, and it's got that more defensive kind of core infrastructure, mostly utility companies in the portfolio, providing that defense in shaky markets. And so that's an ideal product to replace some of that fixed income exposure in portfolios.
Has that push or that weight of money that's come in as the chase for yields there, and also some of the passive indices or passive investors that are coming in, has that potentially decreased the volatility that we've seen in infrastructure assets or infrastructure stocks?
We haven't seen that. So yes, it's provided some regular support in markets for some of those names. But if I look across the universe, we manage our portfolio to an ex-ante risk or volatility of sort of 8 to 10% annualized. That's versus global equities up around the 15% level. And that really hasn't changed in the last 10 years. There are some pockets where, if you take a look at the wireless communication tower businesses we talked about earlier, American Tower, Crown Castle, SBA Communications in the US, in those, as they've transitioned into REIT structures, they are very large companies. American Tower is a $100 billion company. And so as you put that into a REIT universe, there's a lot of REIT investors that need to own that as part of their indexing system. And so there are areas where you've seen, for technical reasons, a lot of trading in particular names, but it hasn't changed the volatility. And the volatility is complicated by the changing composition of equity indices themselves as well. As you get a whole lot more tech and so on into particularly the US indices, that changes some of the volatility and the beta characteristics of the infrastructure companies.
One of the questions that I have to ask is that a lot of the institutional investors that I deal with, obviously through our events, always think about infrastructure being unlisted. That's their preference because they say they can hide the volatility, or they don't have the volatility that's as present because valuation only happens quarterly or half yearly or yearly. Listed, obviously, there's mark-to-market pricing daily. And I was curious in terms of when you talk to institutional investors, how do they think about, or how do they potentially use listed infrastructure alongside their existing unlisted parts of their portfolio?
Yeah. Listen, it's a thorny issue because at their heart, it's the same assets that we're talking about, whether it's listed or unlisted, same regulators providing same returns. And in fact, over the longer term, you're getting pretty much the same return profile out of listed as you are unlisted. Certainly, some funds will do better than others, et cetera. But underlying same returns, and it makes sense because it's the same returns being allowed by the regulators. The trade-off, you're right, is volatility versus liquidity. And so if we hone in on those two, from the volatility side, it's about a mark-to-model approach in unlisted versus a mark-to-market approach in the listed. It's purely timeframes. We did some work, this is going back 10 years or so now, but we did some work to show if you take a single price point each year for listed and for unlisted, you've got a 90% correlation between the two of them. And that makes sense because, valuers in the unlisted world, look back on listed and what's going on in the listed stocks and adjust, cost of capital and EBITDA multiples and RAB multiples and so on accordingly. But when you get down to that daily pricing cycle, then yes, listed is very volatile. Totally agree with that. The flip side is you've got the liquidity, and that's how a lot of our institutional investors are thinking about it. So they're saying, well, I am willing to take some volatility in that part of my portfolio, and that's a threshold question, because if you're not willing to do that, then stick with unlisted. If I am willing to take some volatility, then I have the ability to say, well, I've got daily tradability on the listed portion of my portfolio. The unlisted portion, listen, it might be 6-month or 12-month liquidity. So that's really more of a strategic, and then I can run the tactical allocation side through the listed market. And so you've got the ability to, increase or decrease your allocation by flipping some more money into listed. You've got the ability to warehouse money in listed while you're waiting for it to get called down into unlisted opportunities. And the flip side, when it comes back from those unlisted funds returning capital, then you can pop it into the listed market for a period of time. So that's how they're thinking about that. And then we have had discussions with a number of investors about running sort of completion portfolios or overlay portfolios. So essentially using the listed market to complement what they're doing on the unlisted side. And it might be, I don't have enough GDP exposure in my unlisted portfolio. Can you get me a bunch of toll roads and airports? Or the flip side, I want to get some more utility exposure in the US, or I want to get some renewable exposure in Europe, type of thing.
Are there specific assets that maybe aren't available in the unlisted space that are only available via the listed environment?
In the unlisted space, you are constrained by the deals that get done, the assets that become available, and so there are a lot of core assets that we see in the particularly in the electricity space and in the listed world that you don't really get in unlisted land, and there you're talking poles, wires, and pipes in the gas and the water space. There are pockets around the world where you can get access to those assets in unlisted, but it's not very general. The corollary of that is, in the US, we're a little light on in terms of airport exposures and toll road exposures, and that's probably the only hole that's in the listed universe globally. Otherwise, pretty much everywhere we go, we've got the ability to build in some utility or some infrastructure exposure.
I'm curious in terms of the opportunity for growth. That's obviously a key part of some of these assets. Do you feel that you end up focusing more on developed countries or developing emerging markets? How do you think about that composition?
We do. We have much higher costs of capital for emerging market companies, and that recognises generally the more nascent nature of regulation and or less than ideal kind of public policy arrangement, and so that as the evolution of public policy becomes less clear, then clearly you need a much higher return to invest into that kind of into that region. We do run a dedicated emerging market strategy, so it's an area that we cover and we look at pretty closely. But in our portfolios, we are generally 75 to 95% exposed to developed markets.
Mm-hmm. So the issue that we definitely can't miss is ESG. It's across all asset classes now. I'm curious in terms of how does it apply specifically to the infrastructure environment? What are the key issues that you end up looking at?
So it's a really difficult area, and that's because the data that you get from the ESG researchers is not of the same level of quality across all companies and all regions and all sectors. And so that becomes very challenging. We have spent many years kind of outsourcing that approach. And in the last year or so, we've actually internalized a lot of that research. So we still use external researchers such as Sustainalytics, now owned by Morningstar, and we've used them since 2012. But in the last couple of years, we've done a lot more of it internally to ensure that we actually have comparability across sectors and across regions. And in our view, a large amount of the current ESG issues that you should be focusing on actually should flow into cash flows. So it should be scenarios that you're running on things like, the direction of public policy vis-a-vis climate change, renewable energy, and so on. And there's not many ESG houses that will help you with those kind of scenarios. That's something that you really need to drive out of the investment side of the business.
All right, that's been a fantastic conversation. Thank you very much for your time today, Nick.
It's been my pleasure. Thank you.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.